All right. Got a global macro update here. Not really an update. We're going to talk a lot about inflation, hyperinflation, what happens to assets, what happens to stocks during these crises. So it'll be pretty interesting. We got a lot of different tabs here that we're going to go through. We're just going to wait a couple of moments just so there are some people who are live within our YouTube. And let's just get the recording all ready to go. Only really want to be looking at this side and downwards. All right. So I think we're going to get this started here. Hey traders, welcome to another global macro update. In this video, we're going to be mainly talking about inflation, hyperinflations, what happens to stocks when these crises occurs. So first things first, what even is inflation? So basically, it's when the prices of assets and goods and services goes up. And we can see that inflation depends on money growth, which obviously the United States has done a lot of, and the velocity of money. So these are the two key factors that are going to play a part in inflation. So the money growth, we already have that. We see that in the monetary base of the United States. We've seen exponential amounts of money printing with bailouts left, right, and center. Basically every industry, every sector is saying we need a bailout, and the Federal Reserve is just printing as much money as really they need without any real worry. They said that they have unlimited amounts of money. They're doing unlimited QE. The next thing is actually going to be the velocity of money. So this is, we can see the velocity of money equals the average number of times an average dollar is used to buy goods and services per unit of time. Obviously, right now with everyone in lockdown, with restaurants, bars, entertainment all closed, the velocity of money has substantially decreased. There is way less people buying, selling, exchanging goods and services because a lot of those services are actually not being able to be used right now because of the lockdown. So we see a massive increase in the money growth, but we see a substantial decline in the velocity of money. So it's a little bit confusing for inflation right now because they're kind of opposing the direction that would cause significant inflation. And before diving into all the different charts here, I just have this summary of the current inflation rate, and we use the CPI number, which is the Consumer Price Index. This is a percentage of the increase or decrease in a monthly basis or a yearly basis for the average basket of goods and services. And we see overall within the main countries that we're going to look at, there's not a lot of inflation occurring. Brazil, and this is on the left hand a monthly, and then the right side is a yearly. Brazil seeing actually a decent amount, 4% in terms of a yearly basis, 0.25 on a monthly. Canada doing not too bad, 2.1. China's 4.3 almost. Germany sitting at 1.5. Greece actually deflationary, so they're actually seeing it go down. Obviously with the huge economic turmoil that they're seeing in Greece. Japan, 0.5% in a year. They've been really trying to get out of a deflationary spiral, and they just have not been able to. Russia, 2.3%. South Korea, 1%. Spain's actually in a deflation right now, especially within a month-to-month, negative 0.383 because of the decrease in velocity. And obviously Spain's getting really hit hard with COVID, so they're going to be basically printing a lot of money in terms of the ECB, as well as just the velocity of money absolutely stopping. So the inflation, like we talked about, is going to decrease due to the velocity of money. Due to the velocity of money that equals the average number of times an average dollar is used to buy goods and services. That's decreasing, so you're seeing deflation within Spain. And even the United States, with all this money printing, a lot of people are causing worry of inflation, but we're actually seeing deflation because of the velocity of money is decreasing so substantially. So, in that said, there is still a worry of inflation in the long term. Yes, right now we're seeing deflation because of the velocity of money decreasing so quickly because of the lockdown, but in time, this is not going to last forever. This will pass, and then things will inevitably get back to a state where restaurants, bars, cruise ships, airlines, are getting to a point where they are taking on customers. There's people going on vacation. There's people going and traveling to different places, people eating out at bars, all that stuff. It's not like it'll get back to 100% because this is a major economic hit that was, for basically the entire globe, but you will start to see the velocity of money start to increase. And that is when you will start to see inflation, in my personal belief. But until that point, there will be deflation continuing because the velocity of money is not able to pick back up, in my personal view. So now let's look at right here, hyperinflation effects on stocks. So periods of inflation, such as what took place in the US during the late 1970s and early 1980s, are generally not looked at as favorable economic times, with prices often rising faster than wages. Hyperinflation is even worse due to extreme rise in prices that accompanies it. The most notorious time of hyperinflation was in Germany right after World War II, when it reportedly took a literal wheelbarrow full of paper money to buy a loaf of bread. During hyperinflation, stocks will rise just like other prices, and we'll look into two examples that have actually taken place in the real world recently, one in Venezuela and the other one in Zimbabwe, looking at the annual inflation rate and then also looking at the stock market during that time to see what in the world happened during these major economic shifts. All right. So the background of inflation, just real quick, hyperinflation is an economic condition resulting in the increase in prices at an extremely high rate. In hyperinflation situations, prices can increase as much as 50% per month, perhaps even more. So we see that these numbers right here, on a monthly basis, we're seeing Brazil at 0.25, we're seeing Canada at 0.5%. These numbers would turn to 50% if we are seeing hyperinflation. We don't really see any numbers that are substantial. I would say the highest one is Portugal, Greece, 1.6. Turkey's really bad, 11% in a yearly basis, which is pretty substantial. But you're seeing inflation rates in the hundreds of percents in these major situations like Venezuela or Zimbabwe. In addition, people who have cash and savings accounts or certificates of deposit will see that cash devalued quickly. So inflation, hyperinflation, anything where you're going to get a percentage of devaluation on a yearly basis will be basically destroying savers. You are causing pain in savers, taking away their value because of the debasement of their currency. The problem that people have making purchases due to hyperinflation can cause companies to have financial problems due to weak economic conditions and may also cause these companies to go bankrupt. So yes, stock prices are rising, but it's not like the actual value of these corporations are increasing. And we'll look at the comparison versus the currency and the actual stock, because what you're comparing it to really matters. So this is the two examples that we're going to go over. Venezuela has a stock market, and the Caracas stock market, I don't exactly know how to say it, index is up nearly 200,000%. Yes, you read that correctly. It's precisely 199,000% up from the market close of February 4th. So you're thinking, holy shit, that's unbelievable. But if you don't know, Venezuela has seen some crazy inflation rates here. This is Venezuela's annual inflation rate. So we see, right now, this isn't exactly up to date. Back in 2018, their annual inflation rate is over 27,000%. That's unbelievable. So that means this number right here, this annual inflation rate, is not 5, it's not 3, it's not 10. It is going to be 27,000%. So you're basically instantly devalued in terms of the currency that you hold on a yearly basis. So you're basically trying to get rid of that as soon as you get it. Now, what happened during this time? We see that during kind of the start of 2018, we saw a massive amount of inflation, massive amount of increase in inflation during January and then kind of onward here. What happened to stocks? What happened to the stocks in Venezuela during this time? Well, we can see this is the IBVC index, that is the Venezuela stock market. During this whole crisis, January 2017 and onwards, it saw a massive exponential increase. But we have to remember, this is comparing stocks in Venezuela to their native currency, the bolivar. So yes, you are seeing the price of these stocks go up, but they're compared to a devaluing currency. So you could have the value of a company remain completely stationary, not moving. But if you're comparing it to something, an asset that is devaluing by the day, you're going to have more units of currency to pay for that same level of value that you're getting within the stock market. And that's why you're seeing huge increases in stock price in these massive difficult times that these economies are facing. So the value of the actual value of the stock, of the equity, is not increasing. It's probably decreasing because of this economic turmoil. But the comparison versus the native currency, the Venezuela bolivar, versus these stocks is represented, showing that the value of the currency is dropping faster than the value of the stock. So you're seeing the stock price go up. It doesn't necessarily mean that the value of the company is increasing. Same thing with Zimbabwe. We saw that in 2016, 2017, kind of at the end of 2016, we saw an annual inflation rate of 100%. That's unbelievable, but it was there for a while. From September 2016 all the way until July of 2017, the annual inflation rate was 100%. Remember that we said in Turkey it was at 11%, and we're kind of looking at it as a pretty high number. We're seeing that obviously just blow through the roof in some of these charts here. But Zimbabwe's inflation rate started to really increase, obviously above 100%, in the fall of 2017, let's say. Now let's see what their stock price, their stock market did during this crisis. This is the Zimbabwe Industrial Index. We can see basically at the start of 2017, like we saw here, started 2017, we started to really see that inflation rate with over 100% in an annual inflation rate. And then in the later half of 2017, it absolutely skyrocketed because the currency that they're using was debased, meaning that the value is just cut and cut and cut and cut. And like we saw in Venezuela, Zimbabwe had the very same situation where, because the currency is going down in value so much, that the stocks are going up because there's more units of currency that's needed to pay for that one share or that one stock. It's not like the actual value and the productivity and the output of these companies are increasing. It's not like these stocks are improving in terms of the quality of the company. It's just the comparison is getting increased due to the debasement of the native currency. So I hope you understand that concept. It's not like stocks are going up. Stocks could remain absolutely stationary, or they could even go down. It's just the debasement of the native currency is making it look like the price of the stock is going up. But it's just the value of the currency that you're comparing it with is going down so substantially that you're getting this type of structure within the stock market. I'm going to get a little bit of water, and then we'll continue on here. No coffee today. So, you're thinking, well, what about the United States? We can see this is the chart dating back all the way to 1928. So this is right before the Great Depression. This was that massive Great Depression. And then we saw an inflationary scare during the 1970s. So around 1970s all the way to the 1980s, this deflationary move to the downside here was when gold was exponentially skyrocketing. So we can see overall we're getting a strong move to the upside when comparing the stock market, the United States stock market, to the US dollar, which we all know has been substantially devalued over time. And since, the initiation of the Fed, I'm sure you've seen the chart of the debasement of the US dollar. And I'll just quickly look at the picture here that will show it very, very clearly. This guy right here, this will show you how quickly we're debasing the US dollar, right? And we can see at 1913, it was $1 when we got off the Bretton Woods. Nixon closes gold window, end of Bretton Woods, beginning of the modern day fiat currency system. This is when they completely took the US dollar off of the Bretton Woods, meaning that you cannot redeem any gold for your US dollars. It is a completely confidence built system where they could print as much as they want. They don't need any reserves of gold, and basically it's let's just print unlimited money until this whole thing blows up, basically. And that's what they've been doing. So you're seeing the debasement of the US dollar creating higher price in the stock market due to the relationship of, instead of just the value of the stocks going up, you're getting a devaluation of the native currency, the US dollar. So you're seeing that huge move to the upside. But this is the big question. What if you are comparing equities to something that is hard money, fixed money that you can't print out of thin air like gold? Well, this is a good understanding of, in my opinion, the true value of stocks. This is going to be the S&P to gold ratio. We can see for one share of the S&P 500, how much gold can you buy for one share of the S&P 500, or vice versa. This interactive chart is the ratio of the S&P 500 market index to the price of gold. The number tells you how many ounces of gold it would take to buy the S&P 500 at any given month. And this also dates back to 1928, same chart that we saw here. But there's a huge difference in the comparison versus the US dollar. We're seeing major price appreciation. But when you're comparing it to gold, something that has fixed supply, that is true money in my personal opinion, we're seeing it pretty well stagnate, just sideways. Yes, we have seen some huge moves to the upside. This is the dot-com boom. This is the best time for stocks in terms of the valuation and the comparison to hard money, where we saw it was over 4.5 here. But you know, we're at the same levels that we were at in 1962. So in terms of the actual value compared to a hard asset, like a hard money like gold, we're not really seeing massive price appreciation. Definitely something to consider. So that's the main bulk of the idea of the video. I do want to get into some charts here, looking at first what happened during the stock market when we were actually having the inflationary crisis, because stocks were going sideways while gold was exponentially increasing. So to finally complete the video, let's go to the Dow Jones Industrial Index during the 1970s. So this was when gold was actually absolutely ballooning. Let's just take a look at historic gold prices here. Well, actually, the previous video we actually did exactly explains that, but we can see during this 10-year period, stocks were relatively completely sideways, while gold was exponentially increasing because there was worry of the confidence in the US dollar decreasing, because they were printing so much to fund government spending on welfare and the Vietnam War that there was not enough gold reserves in reserve in order to exchange the US dollars that's currently in circulation. So they completely cut it off. And now we're seeing, in my opinion, another loss of confidence in the United States dollar, which would mean that gold and BTC and other fixed supply assets, well, in my opinion, will see major price appreciations due to the lack of confidence in the United States dollar. But before that happens, in my opinion, we're going to continue the deflationary spiral that we are in. This is DXY, this is the US dollar index. This is comparing the US dollar to different foreign exchange currencies, like I believe this is around 60% euro, 15% yen. There is some Swiss franc, there is the krone, there's a few other currencies, there's GBP. But mainly it's 60% euro and 15% yen, and then the rest of them is smaller currencies. But we can see that, in my opinion, the US dollar looks pretty strong, and I think we could get another push up here, and this is in confluence with the short that we have on the S&P 500. We do think that it's going to take another leg down. It's going to push down below the recent low, not even testing the low, but actually making a lower low. Now, this means that we're going to have a deflationary move before we get the inflation. But in my opinion, it does make sense unless there's going to be a sudden shift in the velocity of money where there's going to be a lot of interactions between goods and services. The velocity of money is going to continue to go downwards, meaning that there's going to be deflation, and then people are going to be going into the US dollar, which is going to be pretty bearish for US equities. And that's why I'm not super bullish on Bitcoin just yet, although in the longer term, I am probably one of the most bullish individuals on Bitcoin. But in the short term, I do think that this deflationary spiral will continue, meaning that the asset prices that we're looking at, S&P, BTC, will continue to go down, meaning if there is a liquidity event, we could see gold and silver and precious metals and basically assets across the entire board drop as well, like we saw during the last liquidity event in middle or early March. So this is what I'm looking for. Massive bullish push in gold because there's going to be sell-offs in commodities, there's going to be sell-offs in equities, which is going to be because there's a pair. If you're selling commodities, you have to buy US dollar. If you're selling US equities, you have to buy the US dollar. So then if you are going to get a sell-off, you're going to get a move up from DXY. And in my opinion, it is setting up to be a pretty good opportunity here for potential move up. We've broken our squeeze where we have a descending trend line and an ascending zone, push the price towards the apex. We got to push to the upside. We're holding previous levels of resistance as new levels of support. We went from a downtrend to now consolidation sideways, and I think when we do start to see that series of higher high and higher lows, we will get that momentum to push us up back to probably 103, maybe even higher. But at this point in time, I'm not looking for that shift in inflation just yet. I am assuming that there will be more deflation to come until we start to see the numbers change. We see that in the United States right now, the inflation on monthly basis is still negative 0.218. And until we start to see the cost of those goods and services rise, which I think we will in time, I'm going to play this as a deflationary move until we see the stats change. And I think that inflation will hit mainly for the reason that in 2008, you're thinking, why didn't inflation hit everyday goods and services? Well, one, inflation did hit. It was just in assets like stocks and real estate. You saw huge price appreciations in assets. We can see right here because of the QE, right? So it did create inflation just in stocks and real estate, which made the rich even richer. But now with the bailouts for the Main Street, like giving individuals, giving everyday citizens money, that new influx of money, that increased amount of money that is going to be fighting for the same goods and services that everyday individuals are purchasing, that is now going to create inflation, is in the goods and services that all Americans are buying. Because if it was just given to the banks, those banks are going to be purchasing real estate and stocks. But if you're giving it to everyday citizens, they're going to be buying food, they're going to be buying services that are essential. And with more dollars competing for the same service and good, the price is going to increase. You're just needing to see the velocity increase. We're not seeing the velocity increase yet, so we're not seeing the inflation. So as long as this lockdown is occurring, as long as people are not able to purchase goods and services, as long as people are unable to kind of go back to, going to restaurants, bars, vacations, moving money around, you're not going to see inflation. So we're going to have a deflationary spiral until we see that incur, in my personal view. Which means that because of the current political leaders and central bank heads that are, Keynesian economists who think that unlimited money printing is a solution for everything in the world, deflation is the worst humanly thing absolute possible, we have to curb deflation, they're going to overreact. They're going to try to stop deflation as much as possible with no means. And, if the velocity of money continues to go, it's a losing battle for them until this whole thing passes, and then we finally start to see the velocity start to pick up. We can see that, let's just quickly pick up the velocity of money here. I have it within my saved tabs. This is the velocity of money. Let's just do M2. Look how low it's going. Look how low it's been since 2000. So you're seeing the huge collapse of velocity of money, and it's only going to get worse. So once you start to see that velocity pick up again, I do think we're going to have asset prices go up, meaning stock prices will go up, similar to what we saw in huge hyperinflation events like Venezuela, like Zimbabwe, where you saw huge inflation increases, which then increases the stock price because you're comparing it to a devaluing currency. So in the long term, I do think that stocks will obviously pick up and exponentially explode to the upside, but gold, Bitcoin will see even more price appreciation because they are fixed supply, because you can't print unlimited, because they are, in my opinion, still going to be a safe haven. Yes, BTC is probably going to be a safe haven. I know I'm probably going to get a lot of slack for that right now, but look at how well it stores value over a long period of time. It's the best investment over the past decade. So that's my view of the market. I gave you some analogies. I gave you some examples of what happened during previous hyperinflationary periods with Zimbabwe, with Venezuela. Yes, stock prices do go up, but it's not like the value of the stock is going up. It's not like the value of the company, the production, the efficiency is going up. It is actually going down because of the economic turmoil. It's just what you're comparing it to is going so much lower that it actually seems like it's going up. So I know it's confusing. It may be difficult if you think the only money is the United States dollar, but there are other forms of money like gold that you can compare things to that give you, in my opinion, a better judgment of the true value that that asset is holding. So thank you very much for watching. We really hope you enjoyed the video. We will be keeping up with CPI numbers around the globe, not just America, because this is a global central bank money printing frenzy where it's not just the United States printing shit tons of money. Just look globally. All central banks are just saying we have to print as much money as we can to get out of this situation. So there's a lot of new money being printed, and there's a lack of velocity because of the global lockdown. So I think there's going to be a huge shift once this all passes. So we'll keep everyone updated. We really hope you enjoyed the video. And if you do have any questions, drop a comment in the comments section below. So until next time, have a good one, everyone. Alright, so that was the completion of the video. We got 8 people watching on YouTube, which is great. Good morning, Truck Nubs. Happy that you are here today. Let's just get that saved. So if anyone has any questions, definitely drop them in the comments section below. That is the completion of our global macro update. We're trying to get them a little bit shorter, trying to create more ideas that people can attach to instead of just talking about the charts, looking at 1 hour, 4 hour daily time frames, because yes, that is great. Yes, that can provide opportunities, but I think in this particular situation, it makes more sense to talk about the more macro, larger outlook that we personally have because of obviously so many things happening with the economies around the world. So there's a shit ton going on. Oil in itself is like the biggest story, and that's just one part of this whole catastrophe. Look at COVID, look at the money printing, there's so many things happening. And as a person who's very interested in financial markets, I woke up every day super, not excited, but engaged with what's happening. But I know this is a very difficult time for a lot of individuals, so I do wish everyone the best in these challenging times. So that is the completion of the video. Don't really have any more to add. We went over a lot of stuff today. I'm trying to get these in a little bit more of like a storytelling kind of video, which I think would be more beneficial. But yeah, let me know what you think if you got any comments. Thank you for watching, and until next time, have a good one.